Hi everyone and good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. Well, today's episode of the show, we'll be talking about one particular category of mutual fund that has seen a lot of investor interest in the month of April. This is the arbitrage funds. What exactly are there? What kind of returns have they given? What is the potential for returns going forward as well from these funds? Risk factor, suitability, all of this will be discussed today on the show. And to talk about that, I have with me Harshvardhan Roongta. We will, of course, also be addressing any questions or queries that you, the viewers, have with respect to investing, with respect to your mutual fund portfolio. So shoot us any queries. Our email address is themoneyShow@etnow.tv. Well, first up, let's welcome on the show Harsh. Hi, good evening, and thanks so much for joining us today on the show. So to start with, Harsh, the AMFI data that's released every month indicated that we saw a massive amount of inflows in arbitrage funds. To start with, what exactly are arbitrage mutual funds?
Hi, Mubina. Very good evening to you too. When we talk about arbitrage funds, I mean, they are just a simple way, if I have to say it in one line, would be a tax-efficient substitute of a debt fund. So because they're categorized as an equity fund, because most of their investments are done in equity assets. Now, despite being investing into equities, they do not take that on an open call of an equity investment. Let me explain this. So arbitrage, as the word suggests, there is a buy and a sell transaction done simultaneously in a particular stock. And the price difference that has been captured, that is the returns that the investor gets. If I have to put it in simple words, assume a Reliance Industries shares are trading in the cash segment at about 2,000 rupees per share. The same stock is in the futures market trading at about 2,050 rupees. So what this scheme will do, they will buy Reliance in the cash segment and sell in the futures at 2,050, making a profit of 50 rupees on that transaction. And this 50 rupees is the profit that an investor earns. So because it's a buy and a sell simultaneous transaction, there is no volatility associated with investing in the shares of a particular company. So in that context, it becomes a fixed return kind of a thing that a scheme has already generated, and it's not going to be affected by the price movements thereon on that particular stock. And being an equity scheme, it is very tax efficient. So it is, for an investor, if you hold it up to, say, 1 year and you make any gains on that, it is categorized as short-term capital gains on which you pay 15%. And if it's a long-term capital gains beyond 1 year, it is 10%. As compared to a debt scheme where the taxation is, of course, much higher.
Well, yeah, the tax efficiency bit certainly is interesting because you don't have many mutual funds out there that display this, of course, except for the ELSS, but that's designed, to help you efficiently manage your taxation as well. So, Harsh, let's talk about, if you had to sort of compare this maybe with liquid funds, which a lot of individuals do, how would you pitch it, versus liquid funds to start with?
Mubina, liquid funds are a pure debt category fund. So, I'm not getting into the duration of that part saying that you partial emergency funds, etc. Let's not use that right now. So the structure of a liquid fund is such, as per the mandate and investment guidelines, they invest into bonds, debt papers, essentially all debt papers maturing in the next 90 days. So their average maturity of all holdings will be approximately 90 days, and they're investing only into debt papers. So it is a debt fund on which the debt taxation rules apply. So what happens with that? As I mentioned about the arbitrage funds, because being categorized as equity, they have to pay 15% on short term and 10% on long term. In this case, the debt funds have a holding period of 3 years. So in case a person is investing into a liquid fund, if they hold it up to 3 years, then it is categorized as short term, on which you pay the income tax as per your tax slab. So if you're at 30%, you pay 30% tax. And in case you hold it for beyond 3 years, then it is 20% with indexation. So clearly, there is a tax advantage, as I mentioned, in arbitrage funds. But with respect to returns, because they are low duration papers, you will see the return that a liquid fund has generated has been in the range of 3 to 3.5%. And at the same time, in an arbitrage fund, when you see a lot of market volatility, the spreads increase and they are able to capture that, the excess returns that this volatility brings in. So a last 1 year kind of a return from an arbitrage fund would have been approximately 6%, 5 to 6% against the liquid fund return of about 3.5%. So clearly from a return perspective, you're seeing that arbitrage funds are outscoring at the same time from a taxation front. So in that context, and that's the reason you will find that there has been a lot of inflow into arbitrage funds in the month of April.
So then what is the suitability then of these arbitrage funds? I mean, clearly that 2-3% extra return is something all of us are vying for. And I think the way you've explained it, the risk as well looks a little lower compared to maybe other funds. So what is the suitability of the arbitrage fund? What kind of financial goals, objectives can this particular category achieve?
So, well, despite being an equity fund from categorization point of view, this is essentially a product wherein a person would park his debt funds for all monies that are required, say, up to 6 months or 1 year. I mean, it is not really a long-term debt allocation fund kind of a thing that if I'm putting money for a debt allocation for 2 or 3 years or 5 years, then I wouldn't really put my money into arbitrage funds because it's, the returns that an arbitrage fund generates relates a lot and is dependent a lot on the volatility that is in the market. So from a long-term debt allocation, you will need to stick to either short-term, medium-term, or other kind of bond funds. But if you're looking at a short-term requirement of parking your money for say 6 months or up to 1 year, you can look at this. You need to be a little careful with the exit loads as well. Though the exit loads are very, very less. I mean, they're 0.1% if you exit within 30 days. But in any case, we should keep in mind that it's not a fund wherein you invest today and remove after 2 days. That's not the idea. You keep it for say about a 30 days plus and you be there for 6 months to 1 year, then it's a proper allocation. And for any needs that you may have within this period, you can park your money into arbitrage funds.